Stock markets have surged this year on the back of one major assumption. AI is the future, and the infrastructure investment needed to sustain it reaches into trillions of dollars. Semiconductor companies can't produce chips fast enough, and the data center outbuild stretches years into the future. But the list of questions and skeptics is growing. I'm joined by semiconductor sector analyst and portfolio manager Terence Tsai. Terence, hello.
Hi.
Tell me one good reason why you're still convinced of this trade.
The short answer would be I do not think we are in an AI bubble yet.
Yet.
That's the takeaway. That's the punchline.
Yeah. Okay. All right. Well, let's get into that. Get into all the details. So while everything has risen, there are several lines of counter argument that are now appearing the last sort of couple of months. Do you want to just walk us through some of those? I guess the sort of big one in a way is that maybe one of the hyperscalers is going to win here, and does that lead to some sort of burst around OpenAI, or where do you think that takes us?
On the hyperscaler question, I think the first thing is, for investors, historically we're known to be the smart money, but I think the real smart money are the people running these large hyperscalers, these large tech companies. And if you look at the way the companies and management of these companies are behaving, it doesn't look like we are at the peak of a bubble. Because in the 1920s, in the 2000s, the management of these companies were trying to get out. They were going public. They were trying to sell their shares. Over the last 12 months, there's been over $1 trillion in buybacks for the US market. And so if there is a bubble, their actions certainly do not support that argument. In terms of the winners and losers, I think it's really hard to make that judgment today. But from the behavior of the CEOs of these large tech companies, they are investing as if the existence of their companies depend on it. Mm-hmm. They probably have read enough Innovator's Dilemma. They read enough case studies of Xerox and Kodak and Polaroid, of the Nifty 50, such that they're investing with paranoia.
Yeah.
They do not want to be disrupted, and they know the chances are they're likely to be disrupted if history repeats itself. One good example is Google. In the first 5 months of the year, Google was a consensus sell by the market, because they felt their search business was going to be heavily disrupted, and they were not leading in the AI models. But if you've seen the last 6 months, the stock has been on a tear, on the way up. And the reason is because the existential threat to Google has woken up the giant. Their models are now seemingly better than the leading model out there previously, which was OpenAI's ChatGPT. And they've sort of regained the lead for now. And we want that in an environment where the models compete. You don't want OpenAI to roll over and say, oh, well, I guess I've lost. Google, you've gotten it. You want these models to compete, to train more, and because of that, the compute intensity, the demand for compute is going to be up there. It's going to go up.
Yeah, I mean that sort of touches in a way on. Do you think where do you stand on monetization at the moment with this? Are there signs already that the hyperscalers are making money out of AI anywhere?
Right. So a lot of the worries around AI was the bit on monetization, where you're spending so much in CapEx. I think the 4 hyperscalers are spending over $400 billion in CapEx this year. Where's the money coming from, and how are you going to monetize it? Well, first, before the AI frenzy, or before AI took off, the ChatGPT moment, most of these hyperscalers, their cloud revenues were growing at single digits. And now they're all growing at 30%, 40%. So that is true monetization right there, because your core business is growing at a pace that was faster pre-AI, right? So that's just one example of how the monetization has worked out for the hyperscalers and why they think it's worth investing in.
So you're not as worried about that monetization criticism of AI at the moment, that the investment isn't delivering capital?
I I
gains for
I
companies?
I mean, I monitor it. It's something that you have to keep abreast of to make sure the thesis is on track. But so far, it's been tracking better than expectations, right? OpenAI has over 5 times their ARR, annualized recurring revenue, and Anthropic has probably similar numbers. On the quantum, they still look small. I think OpenAI has, Sam Altman said probably 20 billion this year, but it's off a very, very low base. The growth rates are still really, really high. And I think that's the thing with technology. Most humans think linearly in terms of growth, but for a transformational technology such as AI, they grow exponentially, and it's very hard to visualize that for most people. Yeah.
We expect the rates of growth that we're used to, and you have an explosive moment like this, and suddenly something different is happening.
Right. Right.
Yeah. Let's maybe go back a step. So, in general, you're a semiconductor analyst.
Mm-hmm.
How about the semi cycle? Where is that positioned at the moment? What does that tell you?
I think we are we're on a new upcycle. So semiconductors are used in a variety of applications. You have consumer electronics, which is mostly smartphone and PCs. You have your general servers, general purpose servers, and then we have this new end application, which is AI. Now, AI is the only thing that's been working for the semiconductor industry the last 2 years, whereas a lot of the consumer electronics, the analog semiconductors that are used in industrials and cars, they haven't really recovered. This has been a price-driven rally because of the high prices that these AI semiconductors command, but the day-to-day pervasive semiconductors in our daily lives, those haven't recovered. And so if AI demand continues to be strong, and your consumer electronics and your traditional semiconductors recover, it could still, there's some legs to this upcycle.
So what's the argument around the AI demand for chips? I mean, do you see that peaking soon? How does that run from here? I mean, we've all heard the stories of NVIDIA simply can't produce enough to meet demand.
Yeah.
Where does that cycle peak, if you like? Can you see it?
The honest answer is no, and I don't think anyone can call the peak and troughs exactly. But there are some indicators we can look at, right? The first thing is that cycles usually never peak when they're in shortage. The cycles turn when supply exceeds demand. And right now, there are a couple choke points in the semiconductor supply chain that's been squeezing out supply like a toothpaste. These players have obviously very strong bargaining power, very strong technology leadership, and that's why they get to control how much capacity and how much production they want. So players like TSMC, for example, right? They refuse to overbuild, even though the customers are going to them and say we need more, and they do their own assessment and they decide what is true demand, and these are the allocations you're going to get. So I think we have very rational players who have gone through many semiconductor cycles, and the other ones like memory, Samsung and SK Hynix and Micron. Most of them do not have a ton of clean room. You need clean room space to produce chips, memory chips, and they don't have that for next year. And so even though demand is great, if you want to pull in equipment, you want to increase your capacity, you got to wait 2 years because you need to build a fab, you need to pull in equipment. So these players and these choke points have kind of kept the supply in place, which is why that's why we're still under shipping demand. And so NVIDIA, you can argue NVIDIA's revenue or profits are capped by what TSMC and the memory players are willing to produce.
So does that say to you that actually there is still a lot further to go just on that pure chip build out?
I think so. If you look at a typical semiconductor cycle, you start with you probably the down cycle probably starts when you have a lot of inventory in the system.
Yeah.
Why is there inventory? Because when the cycle was turning and when demand was good, everyone wanted to hoard inventory. because in the past, when demand was good, I didn't have enough stuff to sell. And so once supply starts to expand and loosen, and the gap between demand and supply started to narrow, the companies wanted to hoard inventory as a buffer, because they were probably getting screamed at by their clients over the last 6-12 months for not supplying enough chips. And all of a sudden you see supply start to expand and demand maybe start to trail off, and you have all this inventory on hand and you realize, oh, demand isn't actually that great. I got to start to rationalize and digest my inventory. And so across the supply chain, you telling the next person on the supply chain says, I don't need any more.
Yeah.
And so I just need to digest my inventory. And that's when the entire industry are put on brakes.
But we're still a long way off that in your
experience. We have no inventory.
Yeah.
Whatever's produced by TSMC goes straight to NVIDIA, that goes straight to the data centers to flip the switch.
Yeah.
In fact, NVIDIA wouldn't sell you a server rack unless you can show them that your data centers are set up with the liquid cooling and the power and everything's ready. So you can it's just plug and play. So we're going from hand to mouth right now.
Right.
There hasn't been any inventory built up in the system. So there's nothing to digest. Usually the semiconductor down cycles happen when you have a ton of inventory, which was what happened during COVID, because everyone bought all these consumer electronics and you had to digest them over time.
Yeah. Okay, so that sort of takes us on to a different bit of the argument. The big one that you were talking to me about the other day is the Michael Burry argument. Everybody knows him as the guy who shorted mortgage bonds ahead of the financial crisis,
right,
and waited forever for it to come good.
Yeah.
He's also made some arguments about depreciation of chip values, that the changes that some of the companies made are really what's driven a lot of the changes in valuation here. Does that make sense to you?
I think Michael Burry obviously has that really great trade during the financial crisis that's his claim to fame. I would respectfully disagree with him on this point. So his argument was that the hyperscalers were inflating their profits because they were extending the GPU depreciation period. And the first thing I'll make is the GPU depreciation schedules, or the data center depreciation schedules, were first extended in 2021. This was before the AI cycle really took off. And I think what he misses is that the nature of data centers have changed from something more of a storage, where we store our photos and videos, to something that's more compute driven. It's used to make tokens, which you can produce and sell. So it's gone from a cost to more of a revenue generators for these companies. And the third thing is, by his definition or by his logic, you can't buy companies like TSMC as well. Mm-hmm. Because TSMC has a new product every year, a new advanced node coming out every year, 2 nanometers, 3 nanometers. And they depreciate their equipment aggressively as well over 5 years. But the legacy nodes that TSMC produces, that TSMC has in their capacity, continue to make a lot of money. In fact, they're one of the most profitable capacity for TSMC. So I don't think that's...
Why is that?
Because the equipment are fully depreciated.
Right.
And whatever you make goes straight to profit.
Right.
In fact, when you think about TSMC's latest node, the 2 nanometers that's coming out, the CFO was guiding for a margin dilution in the early years because of the depreciation pressures. The older nodes do not have that pressure from depreciation, and that's why they are very, very profitable for TSMC.
So they're still producing, but they've been fully paid for, essentially.
Right. The key is not whether it's depreciated or not depreciated. I mean, that is a timing issue. The key is whether there's more demand than supply. So the legacy nodes that TSMC still makes on the 7 nanometer, 28 nanometers, these are used maybe in consumer electronics, maybe used in cars, maybe used in your home appliances like your refrigerators and toasters. The question is, do you have enough demand for those to keep these fabs full? If you do, then these are very, very profitable. If you don't, then your profits are gonna come down, your margins are gonna come down because you can't fill up the fabs. It's the same with AI demand on the AI chips. The older NVIDIA chips, the Hopper series, the Ampere series, are still fetching great prices. They're still very, very profitable for these hyperscalers because compute demand is off the charts. And the users of these chips, of these compute, they have to allocate and rationalize which models am I going to be using to train on the latest chips, and that's good for me, and which models or which use cases that are maybe less compute intensive that will be trained on the legacy chips that will be a lower cost for me. And yeah, so as long as compute demand is there, all these legacy chips continue to be very, very profitable for the hyperscalers.
Okay. Just stepping sideways a little bit, are there other AI plays we should be investing in Asia and globally? I mean, what are the next big winners, do you think, from this whole trade?
I think globally, the hardware trade is relatively well known, not just in the US, but also the NVIDIA and ASIC, which is the hyperscaler, their own designed chip supply chains. I think these are well known, and they've all performed quite well over the last 2 years. I think the area where it's maybe misunderstood by the market might be on software and IT services. To date, they have been seen as a AI loser. If you look at the software ETF called IGV, there are really only 4 companies or 3 or 4 companies that have outperformed, have been driving the returns. You have Microsoft, Palantir, Oracle, then maybe Intuit. Sometimes they're in and out. They're very close to the average. So it's been a very narrow, and these are all infrastructure plays, right? Infrastructure software. Whereas SaaS, software as a service, so enterprise software, has been largely viewed as an AI loser. The main reason is they think there are going to be less seats, so you need less software engineers and developers, and so you have less licenses to sell to. And the second thing is you might just use AI as a prompt, and you can kind of make your own software or aggregate your own software, and you don't need to pay up for these. I think both are largely overblown. I don't think that's the case, but the narrative has been very, very negative. And I think it will take time for these companies to show their value as an incumbent on what they're able to use AI to enhance their products and upsell a lot of the services that they can provide to the customers.
So in a word, you don't think the software companies are going to be as big losers as everybody has previously expected?
I don't think they're going to be big losers across the board. I think this is where active stock picking matters. Identifying the companies that are probably going to survive and come out stronger at the end of the tunnel would be key. Yeah.
Okay.
I think software companies with a lot of industry experience, like vertical softwares, maybe only in industrials or in healthcare or in certain industry verticals. It's all about process. It's all about, do you understand how this industry works? And software helps you automate a lot of these things. And if those are really, really hard to replicate with AI right away. The other thing would be companies with a lot of work history or relationship with their customers, and they have a treasure trove of data that they've accumulated. It's the incumbents to lose, because AI's value, it comes from the data you have, and if you're able to use that data to help your customers come up with better solutions, either on revenue generating ideas or cost productivity solutions, then you would be the winners and the victors of the AI era.
Okay. Is there a slightly different conversation in Asia? Is Asia still just about picks and shovels, TSMC, the other sort of big chip producing companies, or is there something different now, maybe in China?
I think in China, well, first we had the DeepSeek moment in January, and our team was quite fortunate that we spotted this trend or this phenomenon pretty early on. And it's totally revolutionized or changed the narrative for China tech. China tech's been largely left for dead the last, a year ago at this time. I would say the narrative was, China was going to be a long-term loser in tech because the narrative was you need compute, you need high-end compute to win in large language models and in technology. And China had export restrictions from the US, and so they were not getting access to the latest and greatest NVIDIA chips. And because of that, they would fall way, way behind. What China did was they were able to work within these constraints and focus on the model optimization and able to have models that perform very, very close to what their US peers could do on much less capex. So they invested a fraction of the US capex, but the models are probably 80-90% just as good. So China focuses on a different way, a different philosophy on AI. It's very pragmatic. It's about adoption, mass adoption. How can I get the cost low so that more people would use it? And if you look at the token cost, the cost per token for Chinese models such as QN, which is Alibaba's model, or DeepSeek versus those of Anthropic's and ChatGPT, they're a fraction of what they cost. And that's why you see AI much more, the proliferation of AI in terms of adoption in China has grown much quicker than I would say the US. And that's good for them.
So what's the implication for you as an investor? Are you going to be more in on China as a result?
We've been very bullish on China since that DeepSeek moment. And we thought there was a gap between the market expectations or what the market thought China were in terms of its AI journey and where we thought it could get to. And so China's been a great market for us. There's been very, very strong leaders. China produces 3 times as many STEM graduates as the US. I mean, just from AI is all about talent, right? You look at Meta throwing, NBA-sized paychecks at these AI researchers because it's all about talent. And China has a lot of that talent. And so I think in the long term, what China lacks in compute intensity, they can overcome. And right now the two things we lack in that are restricting AI is compute and power. China lacks compute, the US lacks power. Right? China has abundant power, and so we'll see. It'll be interesting to see which one is able to work around its constraints.
Thanks very much, Terence.
Yeah.